Hello and welcome back to the channel. My name is Zach Collins and this is Financial Education. For those of you that don't know me, what is my background? I was a financial advisor in my past, fully licensed, fully FISA compliant, specialized in super and non-super investments. I'm not licensed anymore, but I would love to get them back one day. I left the industry as I could not stand the owner of the business and I've got no interest in sales. It's not all sales, but my passion is to help people, not to sell various managed funds or insurance products. These days, I work in tax and compliance. Today, I want to talk about the myth and misinformation that keeps popping up online. In Australia, our credit card system is very different to that of the US. Over there, you need to get a credit card and a car loan and other different types of loans, and the more debt you have, the better. Over here, do not do that. We treat credit and debt very different to how they do it over there. And you need to be very careful with how you apply for credit as it can negatively affect you. To start with the basics, what is a credit score? So a credit score is a system used by the banks to determine whether or not they will lend you money. There are a number of different agencies that will log your credit. The main ones are Experian, Equifax, and Illion. What the banks do is they go through these three agencies and they will check your credit. What this means is that they look and see how much debt you have, who that debt is with, what type of debt it is, and whether or not you're paying it on time. If you do pay your debt on time and you don't default, you'll have a very good high credit score. If you don't pay on time and you default on any debt, your credit falls. And it makes it likely that, when you do apply for more credit in the future, it will be rejected. What are the different types of debt you can have? So I mentioned a few earlier, but the main ones are credit cards, personal loans, car loans, and mortgages. Credit is not that big a deal here as it is in the States. Over there, you need to get a credit card and you need to build up a score before you can then get a car loan. And then you need a car loan to get a personal loan. And then you need all of these different types of loans to get a mortgage. And the more debt you have and you pay back, the better your score, and the better your score, the lower the interest rate that debt providers are willing to give you. Yeah, nah, screw that, mate. I'm so glad we do not have to deal with that nonsense. Over here, you do not need to cultivate a credit score. I have personally never had a credit card, and I've never had a personal loan. Over here, all you need to do is you pay off your debt. If you have a postpaid phone plan with a provider, that goes on your credit score. If you have a utility bill, that goes on your credit score. A bank will not give you a mortgage because you've never had credit debt. If anything, they will consider that a positive. When it comes to the interest rate on mortgages, it is standardized here. The advertised rate is what you will get. If the bank is willing to provide you a mortgage, whether you have a credit score of 600 or 1,000, it's irrelevant. You're both getting the exact same mortgage. The banks, I only consider your credit score when it is really, really bad. If you've had a number of defaults and proof that you're unlikely to pay that back the loan, that's when they will consider not giving you any money. However, anything else they don't really care. All they care about is serviceability. When it comes to serviceability, having more debt is going to hurt more than having a lower credit score. If you want to get a mortgage, you should be closing all your other debt if possible. When it comes to credit cards, banks assume that the credit card is always maxed out. Let's say you have a $2,000 limit. Even if you only use half of that and you pay it off each month, the banks assume it's maxed out. For every dollar of credit on your credit card, it limits your borrowing for a mortgage, say around about $10,000 by 10 times. So if your credit card is $2,000, it means that's $20,000 less on your max borrowing power for your future home loan. Same for personal loans, except they're a bit lower. They reduce your borrowing power by around 7 times. So a $5,000 personal loan limits your borrowing capacity by 35 grand. Car loans are the best, other than mortgages, of course. But car loans, you're looking at maybe around 5 times. So $20,000 car loan is a $100,000 reduction in your borrowing capacity. So mortgages are the best as they don't actually lower your borrowing capacity. If you have a max borrowing capacity of $1 million and you've got a mortgage of 500, you can still borrow another $500,000. So you still have that same maximum cap of $1 million. As I said, serviceability is what is important. The banks will lend you only based on your income, not your credit score. This is another way that we are different to those in the States. If you have $10 million in assets and $5 million in loans, you've got a net worth of $5 million. Over there, you can borrow against your assets if you have a good credit score, and you can get a good rate. Over here, someone in that same scenario, they could do the same. However, they also need active income. That is, you need income from a job to get a loan. If you have those assets but no job and no income from that job, the banks will give you nothing. My uncle, for example, is in New Zealand. They've got a very similar lending structure to us here in Australia. And he has a number of investment properties that he lives off the rental income. He has a super low LVR and he wanted to refinance back when rates were cheap a couple of years ago. Now, New Zealand has, as I said, has a very similar debt structure to Australia, and he was not able to get another mortgage to reborrow against those assets because he didn't have any employment income, no active income. The app broker actually said that if he wanted to get another loan and refinance, he had to get a job, even for 6 months to qualify for that loan before he could quit because he could service it. He just needed the active income as proof. So debt is very different in different places. So if you want to live, in somewhere else around the world, you need to be very cognizant of how it works. Because if you're used to it in one place and one structure, you know what you need here, but you don't know what you need somewhere else. And if it's very different, you could be in strife. Hopefully I've been able to help you better understand how credit works here in Australia, and you stop believing the incorrect myth that keeps popping up in phones online. So if you've got any more questions, please feel free to drop a comment below and I'll answer it if I can. Thank you guys so much for watching, and I'll see you in the next one.